The CEO of REDFIN, which is one of the largest real estate brokerages in the country, just did an interview with CNBC where he said that the housing market already hit rock bottom in the early part of 2024 and now it's going to get better from here on. Take a listen.
But mostly we hit rock bottom in the first quarter of 2024. And I would expect the housing market to do a little bit better through the rest of the year.
Now, everybody knows that the housing market has been crazy. If you've been reading market briefs, you've been getting daily updates on this. But back in 2019, the median home in America was selling for $258,000. Fast forward to 2024, and the median home in America is selling for $433,000. But this is just one part of the picture. See, it's not just how much you have to pay to purchase the home. It's also how much the home is going to cost you every single month, because back in 2019, you could get a mortgage for around 4.5%. And if you put 20% down to purchase this $258,000 home, that means that you would pay $1,050 a month for your mortgage. If we fast forward to today, mortgage rates are around 7%. If you put 20% down to purchase this home, not only are you going to need more dollars, but now your monthly payments are going to jump up to $2,305 a month for a similar median home. What does that mean? That your monthly cost of home ownership has grown by around 119%, which is why it has become so much more difficult for people to purchase a home, because during the same time, well, household incomes have increased, but not 119%. How much have household incomes increased over the last 5 years? By around 20%. So people are making more money. People are making around 20% more money on average. But home prices have grown significantly faster than 20%. And your monthly costs of home ownership have grown by around 119%. And this is why many people in America are either choosing to or being forced to rent for longer, because for a lot of people, it's cheaper to rent than own. But we got some good news for tenants, bad news for landlords, which is that rental prices are falling in many cities across America now. Take a listen.
So it does seem like we are seeing cooling off in rental prices.
Yeah, especially in markets where there's luxury rental apartment buildings. That's where you're seeing some of the softness. So it's just another reason for optimism.
But what I think is the most interesting part of this equation is, despite the run-up in home prices and despite the run-up in mortgage rates, people are still buying homes. Like the same day that the CEO of REDFIN did this interview, the National Association of Realtors released a report which said that in April, home sales fell for the second month in a row, but home prices continued to rise. Now, at first glance, that might seem strange, because if home sales are falling, why are home prices also rising? Well, it could be partially because home buyers are finally seeing a little bit of a break on mortgage rates, which means that now, because mortgage rates are starting to come a little bit lower, some people are seeing mortgage rates under 7%. That means instead of offering $528,000 for their home, maybe you can offer $562,000 for their home. That way, you can go out and buy that dream home that you wanted. So what all of this tells me is that we are in a crazy housing market. But this is where the CEO of REDFIN says that we have hit rock bottom and it's going to get better from here. But if we've hit rock bottom, I guess the question is, what does that mean for the housing market going forward? Does that mean the home prices are going to go up, down, sideways? Well, take a listen.
We think the housing market is going to improve over the next half of the year.
To explain what that means, mortgage rates were around 8% back in the late part of 2023, and now they're falling to around 7% and in some instances under 7%, which means if you're going to buy a home, it's a little bit cheaper on the mortgage side. And because it's cheaper on the mortgage side, that means maybe you have a little bit more negotiating room to go out and offer more dollars to go out and purchase the home. And hopefully, if we start to see a little bit more demand on the purchasing side, if we start to see a little bit lower mortgage rates, then maybe that means sellers might be more inclined to want to sell their homes, which could potentially increase the supply to give you more options on a home that you want to purchase. Now, he's also very hopeful that mortgage rates are going to fall even further in 2024, because what he said is that inflation is finally softening. This is going to give the Federal Reserve Bank, which is the central bank of the United States, fuel to cut interest rates even more. We've been covering this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in things like housing and crypto and the global economy, our own economy, and stocks into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below, where you can go to briefs.co/market. But this is where I want you to understand that not a crazy housing market depends on who you ask. Because if you own a home and you're thinking about selling a home, having a market where you have a lot of buyers, not that many sellers is good for you, because that means you can still sell your home for potentially over asking. If you're a buyer, you want something different, because what's good for a seller is different than a buyer. And this is where what is a good housing market is very subjective. And that's why I want you to take everything that you hear on the internet with a little bit of a grain of salt, because you got to remember that the CEO of REDFIN also wants to see something happen in the housing market. Because remember, how do realtors make money? Realtors make money when you buy a home or when you sell a home. And they want to see more home transactions. The more transactions that happen, the more money they make. Whether the market's going up or down, as long as somebody's buying and selling a home, they are making money. Now, the difficult part for transactional-based businesses in the housing market, meaning realtors and mortgage brokers and even title insurance companies, is they started to see a real slowdown in sales last year and even this year. And so now, if you're a realtor, if you're a mortgage broker, if you're a title insurance agent, and if you're running on commission, and you're just kind of, let's just say, a middle of the ground person, well, chances are you're making less money. Even if home prices are selling for more, you might be making less money because less transactions are happening. And so now, if you're kind of considering what industry you want to be in, you got to make sure that your boss is encouraging you that things are going to get better, there are going to be more transactions because, well, they want to keep you in that industry. Now, of course, nobody can predict what's going to happen, but you just got to understand where somebody's coming from when they're talking. But the second part of this equation is you also got to understand that real estate is very localized. Because right now what we're seeing is that home prices are still booming in the Midwest in states like Michigan. Shout out Detroit. Because people are moving in and you have more demand than supply. People are willing to still overpay for prices in the Midwest, and that's continuing to push home prices up and even rental prices up in the Midwest. But in other areas, especially some of the big cities which saw that big boom after the pandemic, well, in many of those cities, you're seeing rental prices fall and you're also seeing home prices fall, which is good if you're a buyer in the area, but it's not good if you're a seller in the area, which is why, again, it's subjective. What is rock bottom? What is good? What is bad? The 2008 crash was bad for people who got foreclosed on, but it was great for people who were buying homes in 2010, 2011, 2012, 2013, 2014, 2015. Because if you're buying a home then, you could buy a home for half off in some instances, depending on where you were buying. And the last thing that I want you to remember is that it's very difficult to time a market, let alone the housing market. Because number one, the housing market moves very slowly. It's not like the stock market where you can buy and sell a stock with the click of a button. Home prices move a whole lot slower. And home prices move up faster than they move down. Because let's just say you're a seller. You own a home that you want to sell for $500,000. If I offer you $600,000, you're not going to say, oh no, that's too much money. You're going to say, oh yeah, give me that $600,000. So you're more likely to sell your home for more money. But if I came to you and said, hey, your home is listed for $500,000, will you sell it to me for $400,000? You're going to say, no, I'm going to keep my home on the market for a little bit longer. And maybe after 3 weeks of no offers, you might say, I'm going to cut the home listing from $500,000 to $485,000 to see what happens. See, home prices move down slower than they move up. And that's why you got to understand, home prices don't move that quickly. And there's a lot of factors that impact the housing market, because now you have to look at what's happening with inflation, what's happening with the economy, and what's going on with interest rates. Because obviously some people are going to be much more gung-ho that interest rates are going to go down. Other people are going to say, no, interest rates need to stay high. And at the end of the day, we don't know what the Federal Reserve Bank is going to do. But the Federal Reserve Bank has said they're the central bank of the United States. They are the entity that's in charge of deciding what's going to happen with interest rates. Not mortgage rates, interest rates. The interest rates that the Federal Reserve Bank sets are the interest rates that banks charge one another. You could think of it like the wholesale rate that banks get to borrow money at. When interest rates are higher, banks have to charge you higher prices for the retail price, which is the mortgage rate. So, when the Federal Reserve Bank decides to cut interest rates, that could help push mortgage rates lower. But when will they do that? We don't know. Now, what the Federal Reserve Bank says is that it is going to depend on inflation. And for most of 2024, up until last month, what we saw is that inflation came in hotter than expected, hotter than expected, hotter than expected, and then last month it came in at expected. And because last month it came in at expectations, many people are not hopeful that the Federal Reserve Bank will start cutting interest rates. But they have to do a balancing act here. Because if they start cutting interest rates too soon, well, what would happen? Let's play it out. Let's assume that mortgage rates go from 7% to 4%. It's easier to understand when you have more extremes. What would happen tomorrow? Well, if mortgage rates were 4% tomorrow, everybody, including your broke cousin Bunty, is going to want to go out and buy a home. Now, if you see this, let's just call it a new sudden demand in wannabe home buyers, what's going to happen next? Well, if you have a home and you list it for sale for $500,000, you'll probably have 37 different showings tomorrow, and you might get 15 offers. And if now 15 people are competing to purchase your home, they might start bidding against each other with higher prices, which would then push home prices up. Now, as a buyer, you might say, well, at least I can save money on the monthly payment because I might have to pay $50,000, $70,000 more, but my monthly costs are lower. Sure, let's just stick with the hypothetical, but let's assume now home prices start to rise again. What does that mean? Well, if home prices start to rise, it goes back to the original reason why the Federal Reserve Bank had to raise interest rates in the first place. Inflation, housing costs. And so this is where you got to understand, cutting interest rates is not so easy. There's a lot of different factors at play here. And in order for the Federal Reserve Bank to actually start cutting interest rates, there's going to have to be some real change in the economy and inflation. We're not there yet. Now, sure, maybe the Federal Reserve Bank could completely change their mind and do something different. But based off the information we have today, you got to understand, we're still quite a bit of a ways away from 2% inflation. And so now, when you're making your decisions, the main thing that I want you to understand, if you're thinking about buying a home, is make sure you can afford it. Don't worry about trying to time the market, just make sure you can afford it. What does that mean? Afford the down payment, afford the monthly payment, and afford the move-in costs. Because, well, if you're going to move in, you need movers, which are expensive. If you're going to make upgrades, that can be expensive. And if you're going to buy new furniture, that's going to be expensive. Just make sure you can budget it. If you can afford it, go on and buy it. If you can't afford it, well, work to save up some more money so you can go out and actually afford a home that you want to buy. They innovated the way that they invest money, and they've been able to get very good returns over the last number of years. And what the CEO of Bridgewater is saying now is that the next 10 years or 15 years of the economy might not be like the last 15 years. Take a look. When you look at the last 15 years, the stars have aligned for investors. It's been a tremendous period.